Markets are blood red. And in today's video, I will be going over what I think about the stock market correction or possible crash that we're having right now. So in this video, we'll be looking at some of the charts as well as some of the commentary I provided my Patreon members over the past couple of weeks. Just about a week ago, I put out a video saying that the stock market is crashing and here's what I think. And in there, I did some technical analysis on the QQQ as well as the SPY. And at that point in time, I was not really interested in buying stocks just quite yet. When I released that video, it was actually on February 25th, right here. And the stock market already dropped quite a bit that day. It was down, if we just check this indicator, it was down about around 8%. But at that point, I said I expect the market correction to be somewhere between 10 and 15%, and that's probably when I'll start buying. And today, looking at the QQQ, we're actually down at around 11.5% from the previous all-time high here on February 16th. Now, if we jump over to the SPY or the S&P 500 ETF, let's just take a look at how far we're down from the previous all-time high. So today we dropped as low as about 5.8% from the previous all-time high. And honestly, that's not too much of a correction for the SPY. But obviously right now we can see that it's been a tech-heavy sell-off because the NASDAQ, which is tech-heavy, is selling off like crazy. And looking at the S&P 500 heat map today, we can see that a lot of the technology and a lot of the big tech names here, you can see like Tesla, Amazon, Disney, Netflix, Apple, Microsoft, they were all down a bit. There wasn't much green on the board, but we can see that energy has been quite green. They're like bright green right here versus the rest of the map is kind of dull red and bright red in semiconductors, for example. There were a couple other companies like Facebook and Google, and I think these two companies are just lagging behind the rest of tech, which is possibly why they were up today. If we turn our attention over the fear and greed index, we can see that right now we're on a neutral position at a 48. So we're not quite yet at extreme fear. I expect maybe we'll pull back to around the 25 level in between neutral and extreme fear. And right now there hasn't been any sort of crazy event or black swan event that has taken the world by surprise. The only real thing that we're seeing is US Treasury rates rising. You can see over the past month, if we check out this chart, they've been rising quite a bit. They started around 1.14, and on this day here, there was a lot of fear in the market. The market sold off. I believe it was on February 25th, actually, the day that I released my video, when the Treasury rate hit all-time highs, like a one-year all-time high of 1.5%. But still, if we go back like 3 years, for example, we can see that a 1.5% treasury rate is actually nothing compared to a while ago. In 2018 and 2019, the treasury rate or the 10-year treasury rate was around 2.6 or even at around 3%. But you can see that the treasury rate is kind of rising parabolically, and this has gotten investors a little bit spooked. Because as the treasury note interest starts to go up, what this means is the bond market interest goes up. And what bonds are used for essentially is to allow companies to raise capital and pay back interest on that. And typically bonds have a higher interest than the 10-year US Treasury note. So bonds might be at 3 or 4% right now. And when bonds continue to go up and up and up, then it just makes it more expensive for companies to borrow. And when companies find it more expensive to borrow, they'll borrow less, and therefore their growth will also be slowed down. Because a lot of these companies that we're investing in, especially for myself, these high growth names, they need to borrow money in order to continue fueling their growth. A lot of these companies are not profitable. Some of the big names this year like DocuSign, which really benefited from the stay-at-home trend, their EPS is negative $1.19 per share, so clearly they're not earning anything per share. Other high-flying stocks like Twilio, they have an EPS of negative $3.35 per share. Okta is another favorite name with an EPS of negative 1.92. CrowdStrike is another favorite name as well. They have an EPS of negative 0.48. And all these names I just mentioned here, they're high-flying tech names. They're not profitable. And right now, investors are getting out of these high-flying names and going back into sectors like energy. A lot of these energy names have been lagging behind the general market because everyone's like EVs, EVs, EVs. But these companies, for the most part, at least the ones that have been around for a while, are profitable. And another thing that might be boosting the energy sector is the fact that we're coming out of the pandemic very soon. According to the CNN article, Biden now says the US will have enough vaccine for every adult by the end of May. So basically he's saying that around 2 months from now, everyone who wants a vaccine could be vaccinated, and therefore people could go back to going out outdoors, no more masks anymore, they can go travel. And a lot of these things that people go out and do require cars, transportation, and therefore the oil and gas sector will all of a sudden see a spike in demand because the world yet has not turned to EV cars as a major source of transportation, and airplanes are not yet electric, so the oil and gas industry is set to boom. The oil and gas industry has been hit quite hard. Right here I pull up the United States Oil Fund, which is an exchange-traded fund that attempts to track the price of West Texas Intermediate light sweet crude oil. And you can see the chart here, it looks pretty bad. So in December 2019, it was at a high of around $105 per share. And when the coronavirus hit, it dropped all the way down to $18.86. It lost roughly around 81% of its value. However, since the lows of March, it's actually risen by 109%. But yet it's still down quite significantly. It's down about 59% from its previous kind of all-time highs in 2020, early 2020. From its actual all-time highs in 2018 here, it's down just about 65 or 66%. So oil is down quite a bit, yet from its previous all-time lows, it's recovering from there. Now I just want to quickly scroll over to my Patreon group just to give you guys an idea of what updates I'm giving people. So on February 23rd, I said to strap in, this may be the market correction we've been waiting for. On February 23rd, the QQQ has reached its 50-day moving average. And I felt like we were in for a correction at this point just because we haven't seen a major correction. We saw like a small one right here, but I wouldn't really call that a correction. And I felt like it's been quite a while since the previous moves. They were in the fall time. And ever since then, we've been running up quite a bit. Because we touched the 50-day moving average, and the last 2 times that we touched it, we saw a bit more selling pressure. That's why I sent that message on February 23rd. I also pull up a picture here of FinViz with the heat map of the S&P 500, and it also showed that tech was blood red, but the other sectors looked a little bit more scattered. Basically, I felt like there was sector rotation happening on this day here. I also mentioned on the exact same day, we're seeing some sort of dead cat bounce play on the market today. And what a dead cat bounce means is the fact that when the market sells off quite a bit, it's going to bounce up a little bit, but the bounce up is not going to take it to new all-time highs. Rather, it's going to drop back down. Basically, the bounce is going to die and the stock market will plummet even more, which ultimately, I guess, my analysis or my prediction ended up playing out correctly. However, these don't happen all the time. I just happened to be right this time, and my analysis happened to be right. I state later on that usually a correction is anywhere from 10 to 20%, and they happen over a week or two. So the week or two so far hasn't played out correctly. It's been more like 3 weeks so far, and we could possibly see another week out of that. I also did sell out of a few positions on the 23rd that day when there was a dead cat bounce. Some of those positions I believe included Hive as well as Lightspeed. On February 25th, I showed my Patreon group some Fibonacci retracements of the S&P 500 and just showing what levels it came back down from previous corrections. On February 25th, I did some more technical analysis for my Patreons here, and you can see that I did a Fibonacci retracement on the S&P 500, showing that it dropped back down to the 61.8% level, which is the golden level, and bounced off fairly convincingly. And I also drew the Fibonacci retracement on the S&P 500 and where we were currently, and clearly we haven't yet hit anywhere close to the 61.8 level. And I stated here on the 25th, for now I'm holding to the conviction that we will see lower prices. The next day on February 26th, I drew a shorter term, not the week version, but the day version of the Fibonacci retracement, showing that the S&P 500 did bounce off the 61.8% level. And I did do a little bit of nibbling here, but not too much. So clearly I felt like it was possible that the market could jump back up to new all-time highs because the S&P 500 did hit the 50-day moving average and it bounced off the 61.8% level. Ultimately that didn't play out correctly, but I didn't buy in too much. I probably spent about 10 to 20% of my cash on the sidelines. On March 1st, I didn't buy or sell anything on that day. I said that I'm waiting patiently to see if my theory that the market will drop a bit more comes true. We had a relatively significant green day today, which was a great feeling, and the aftermarkets were also green. I was reviewing some charts today, trying to glean some information as to what investors were thinking. But what I noticed here on the QQQ chart for this day, I noticed that the volume was extremely low. It was half the volume of the previous day. So again, I felt like this run up in the QQQ was very short term because there was very low conviction based on the volume here. Then on March 3rd, I did a more technical analysis showing that the QQQ has this resistance point here, which I drew from this black line. And there's also another support line here on the blue line. And I felt like if we broke down below that, we're probably going to drop even further. If we look at the QQQ, I was probably drawing on the 4-hour line here. And the two trend lines I showed on the chart was one right there. And the second one was right here. And if we broke past this line, I said that we're going to drop down quite significantly. Ultimately, we did, and I guess that prediction was correct this time. And on that same day, I took a snapshot of a heat map showing that there was a rotation again out of technology stocks right here into other sectors like financials, energy, industrials, healthcare, and consumer defense. Also, later on that day, I said that I've been sitting relatively patient, only taking some small positions, but I think we might be nearing time to where I will be deploying cash. Again, I said that the QQQ is near its 100-day moving average, which is the yellow line, and I think that we will be making some plays as we touch there. So we haven't yet hit that 100-day moving average. However, today we did hit that 100-day moving average. I made a few plays in my portfolio, not too many, and I wanted to make more. However, my price targets didn't hit. And if we move on to what I said today in my Discord group on March 4th, I basically showed at lunchtime that the volume candle here was already quite significantly high and we still had about 3 hours left in trading. So I figured it would actually rocket higher than yesterday's candle. And the stock price would drop down further if the candle continued to rise or the volume continued to rise. And looking at today's charts, we can see the volume continued to rise and the candle dropped back a little bit further. However, it did bounce back up at the end of the day. Now let's jump over the charts to see what we can find out from here and what my thoughts are going forwards for the next couple of weeks. So as I mentioned before, just looking at how far down we are from previous all-time highs, we can see that we're down around 11% on the QQQ. If we look back earlier this year, we can see that we had a couple other dips. And these dips actually, we saw a drop of around close to 10% here. The previous dip to that, we also saw it drop around 14%. And if we go all the way back to March, we can see that it dropped around, I think it was 30% or so. Yeah, it dropped around 30% from its all-time highs then. So right now we've dropped about 11%, and I don't think we're going to drop 30% like we saw last year. However, we have reached an interesting level here. We've reached the 100-day moving average. And if we look, last time we hit the 100-day moving average, it bounced off quite convincingly. The next few days, we had 3 Greek candles up, as well as 2 gaps up. Right now, today, we just hit the 100-day moving average, and it did drop a little bit below that. And I think that currently with the markets, we probably could see it drop a little bit lower. At most, it'll touch the 200-day moving average, in my opinion. I don't think the sell-off is done just quite yet, and let me explain why. So here we can see that there's been 3 red candles down here, and the volume was growing stronger and stronger. Last time we saw something like that was back here. We saw 3 red candles, and the next day the volume wasn't as high, but it was still a red candle. And it dropped a bit more. Actually, it dropped quite a bit more. So I think tomorrow maybe the volume of the sell-off might not be as high, but we're still going to see a bit more of a sell-off. And if I go over to my stock list right here, you can see a lot of the stocks that I own, even after hours, they're still down quite significantly. So yeah, essentially what I'm saying is that I don't think the sell-off is just quite yet over. I expect to see a few more red candles down right here. Maybe we'll settle somewhere between the 200-day and the 100-day moving average, trade sideways just like we did here for a couple of days. And then after that, I think we'll bounce back up and maybe kind of stay around the 50-day moving average. I don't know if we're going to go to new all-time highs just because of the interest rates, and people are fearing that borrowing money is going to get more expensive and growth is going to slow down. So my plan right now is to possibly hold off for another day or two. I might nibble a little bit tomorrow depending on what deals I see in the market. There are some pretty sweet deals, but they're also on high growth names and their valuations are still, relatively high in comparison to the past 10 years. So I think I might buy a few things here and there, but I won't be deploying all my cash. I'm going to draw one more thing for you guys here. I'm going to draw the Fibonacci retracement. And I'm doing this on a week chart instead of a day chart. And that's because I think this trend right now we're seeing is a bit of a longer drawn out trend that might happen over, 3 to 4 weeks. So if I draw it right here, you can see that right now we've dropped back down to about the 50% level. Usually the golden number is like the 61.8. So I will be waiting for it to pull back here, and that's probably another signal to deploy even more cash. If we come back to the 100% level, I'll probably dump everything I have and try to find more money to also pour into the market. And, we could keep going below that, but honestly, in my opinion, it's quite doubtful. Looking at a few other indicators, we can see the RSI were quite oversold. We've hit the 30 level, and we haven't seen those levels too often. We didn't even see those levels in these previous two market crashes here. It didn't drop down to the 30. The last time we saw the 30 level was actually during the March lows of the coronavirus crash. And we touched it like 1, 2, 3, 4, 5, 6 times. I know I said the previous Fibonacci retracement was the last thing that I want to show you, but here's one more. So looking at the number of days that the previous corrections took, we can see this previous correction took around 19 days to reach its all-time lows. Now, if we go over to the next one, we can see that it's taking about, 19 to 20 days as well. And then currently with this current market correction, we can see that so far we've spent about 16 days. So I think that we're probably in for another 5 days of a market correction. So I'd say I have about 5 days to buy in heavy before we see the stock prices bounce back up. Now, if we're to have a March correction, which is quite unlikely, that took around 33 days to hit its all-time lows. So if we were to have a March correction right here, then we're only halfway through and we could easily see it drop below the 200-day moving average. Anyways, I want to hear your thoughts down below. What do you guys think about this market crash or market correction? How much longer do you think it's going to go for? And what stocks are you planning to buy? That's all I have for today's video. If you want to check out 2 other videos, they're right on the screen for you right now. If you're there, I'll see you there. If not, keep up the grind and have a great day.